Wednesday, February 26, 2020, MONERO 64, home of alternative economics and contrarian views. Today I want to look at how central banks will be pushing on the string, trying to fight off the effects of this crisis that has emanated from China over a month ago now and is spreading around the world, spreading a lot of uncertainty for the markets, for the economies around the world. I've spoken about this before, previous videos last week, the global supply chain, travel and tourism. It's very uncertain, and markets, of course, hate uncertainty. But I'm going to be looking at a couple of things today. First one is an article in the FT by Nouriel Roubini. And believe me, I don't agree with everything this guy says. I think he's called Dr. Doom or something. It's an opinion piece. He says markets remain complacent about C despite sell-off. And I also want to look at a couple of other articles or reports. First one is Household Debt and Credit Report from the New York Fed for the fourth quarter of 2019. I think this came out earlier in February. And then also an article from Zero Hedge from yesterday entitled Subprime Credit Card Delinquencies Spike to Record High, Surpass Financial Crisis Peak. Those two factors there, the Roubini article and these two articles, will, in my opinion, help explain why, yeah, it will be hard for central banks to get things going again, and why I think they're going to be pushing on a string. Before that today, let's quickly look at the markets because they're very interesting, of course. Yesterday, we dropped almost 900 points after dropping 1,031 points the day before in the Dow. So we've got about 1,900 points in drop in the Dow. S&P as well was down 3%, almost another 100 points. So right now, year to date, the Dow is down 5.1%, S&P is down 3.17%, and actually the NASDAQ composite is virtually unchanged. It's down slightly, 0.08%. So let's quickly look at where the markets are. It's 10 to 8 a.m. London. Yesterday, gold and silver didn't do very well, and actually gold was holding most of the time around 1650. But towards the end of the day, in terms of the stock market, or 4 p.m. New York, they got trashed. I think they got caught in all the selling. I'm not concerned, as I've said before, and I made a video maybe 2 weeks ago, or maybe less, saying that you need to hold on to your gold and precious metals in general for dear life, because we're gonna enter a period of high volatility, but gold and silver are the place to be. They're safe havens. Don't forget, people think that the dollar is a safe haven. Well, the dollar is a debt instrument. Do you really want to hold on to a debt instrument when things are so uncertain and the economies of the world are probably gonna fall into a recession? I personally don't, or at any other time for that matter. So right now, gold has rebounded from the lows yesterday. We're at 1645. I think I noticed the low was 1625 in gold, so we're up 10. Range has been 1634 to 1648. Silver's back above 18. I'm still bullish on silver medium term. I think silver could be moving higher very soon. We're now up 10 cents at 1808. The low has been just below 18. The high has been 1821. Well, not great news for the stock market. The Dow is up 108, but that's not a really huge rebound from what we've seen the last few years. Whenever we see big drops for a day or two, we're bound to get a really strong rebound after that, and we're not getting that. So up 108, yes, it's up, but it's not great. We're at 27,190 in the Dow, up 0.4. S&P is up 14.75 point at 3143, up just under 0.5%. Key level in the S&P, I was listening to a good interview on YouTube yesterday. Chris Martenson of Peak Prosperity interviewed Northman trader Sven Henrik. I recommend that interview. Very interesting. Sven Henrik talks about how the 3,000 level is key for the S&P. He thinks if we break below that, it could portend really bad things for the rest of 2020. NASDAQ 100 future is up 60 or 0.2%. The foreign exchange markets, sterling did rally yesterday. Not sure why, but right now we're down back below 130, 129.92, down 0.1%. Euro fairly steady, 108.75 versus the dollar, and the dollar is up 0.2 versus the yen, Japanese yen, 110.40, and fairly stable or unchanged against the Chinese currency, 703.05. WTI crude down below 50 right now, 49.73, down 1/3%. Another big event yesterday for the markets that you probably won't hear too much in the news because it's the bond market, but it was a significant drop in the 10-year yield to new all-time lows ever. It dropped to just above 130. It broke the low from July 2016 at 132. And why is that bad? Well, it means that bond investors don't see the economy doing well, especially when yields are this low. Well, look at Europe. They've got negative yields. Their economies are not growing anywhere. The 10-year German yield is about minus 50 basis points, and their GDP growth is 0. So this is not good. Right now, the 10-year yield is back up a little bit, just below 1.35%, but we need to keep an eye on this. The 30-year yield is at 182. So the whole of the Treasury yield curve is below the CPI, or inflation if you want to call it, which is running above 2%. So right now, you buy any of these, you're getting a negative real rate. That should be even more positive for precious metals. I know people say, well, you get no interest from gold, but you're getting negative real rates from treasuries. So why will central banks have a hard time getting things going? One point is one made by Nouriel Roubini in his article or opinion piece. Markets remain complacent about the C disease despite sell-off. I'm not going into the reason why the markets are complacent, and I still think they are to some extent complacent. But one thing he said that I thought was interesting is this, and he's talking about central banks, how they have very little firepower left to intervene, especially the banks in Europe, central banks in Europe and in Japan. Only a little lower. The Fed has only 1.5 percentage points of headroom left. It will probably react in the second quarter by cutting rates, leading to short-term market relief. I think they might do it this quarter, actually, in the first quarter, but I could be wrong. But this C outbreak is mostly a negative supply shock. That reduces growth and increases costs and inflation, with some side effects for aggregate demand. Monetary policy cannot resolve negative supply shocks. I agree, but I would also say that there's negative demand shocks, like people not traveling or going out as much. So yeah, that's also part of it, not just the supply. But the supply could be really uncertain. For example, China is the major producer of rare earth metals in the world, and rare earth metals are used for all electronic devices, computers, mobile phones, everything needs these rare earth metals. So this is really, it could get quite disrupted out there, this global supply chain. And that's what the markets don't like, the uncertainty. I think as Nouriel Roubini was saying, markets were expecting this to be resolved in China by the end of the first quarter, and they expected China just to rebound right away. But we're now seeing that it's spreading into other places in the world. For example, I had to look at the Daily Mail online here in the UK. We not only have bad news about flooding, it says burst in the barricades, devastating moment, the River Severn finally bursts over flood defenses in the town of Bewdley, days after residents were warned their homes were under threat following Storm Dennis. So that's not helping. This is the other headline from the Daily Mail. Thousands of Britons face mass C testing at GPs. As worst case government report warns, 500,000 may die in UK amid explosion of infections across Europe. So this is not good. What about the other reason why I think the central banks are pushing on the string? And this is from the New York Fed. Well, this came out a couple of weeks ago or maybe more. It says household debt continues to rise. Mortgage originations hit 14-year high. So this is from the fourth quarter of last year. So we've hit a record here of household debt in the US at a time when things are really uncertain. And I think at a time where demand is going to be affected, people are probably not going to take on as much debt. And this crisis could be a trigger for an implosion of this credit bubble that we've had, or this credit cycle. So here you see, I'll go over the report. The CMD's latest quarterly report on household debt and credit reveals that the total household debt increased by 193 billion or 1.4% to reach 14.15 trillion in the fourth quarter of 2019. This marks the 22nd consecutive quarterly increase, with total household debt now 1.5 trillion higher in nominal terms than the pre-recession peak of 12.68 trillion set in the third quarter of 2008. That rings alarm bells to me. Mortgage originations rose by 224 billion or 42% in the fourth quarter of 2019 to reach 752 billion, the highest volume since the fourth quarter of 2005. So we are at pre-2008 recession levels in terms of household debt, according to the New York Federal Reserve. And then I saw this article yesterday, and this is tied into the debt. And it's actually authored by Wolf Richter of the WolfStreet.com report. And it says, subprime credit card delinquencies spiked to record high, surpass financial crisis peak. So that as well is reaching a record. That's also surpassing pre-08 crisis levels. I'll just quickly go through this. It says the rate of credit card balances that are 30 days or more delinquent at the 4,500 or so commercial banks that are smaller than the top 100 banks spiked to 7.05% in the fourth quarter, the highest delinquency rate in the data going back to the 1980s. So there you go. Back to the 1980s. Yes, maybe lower rates that we're seeing might help people. But one thing that I think is not going to help or encourage is people to borrow more. And you can see why, because we are record levels of household debt. We're at record levels of credit card delinquency rates. And now we've got this crisis, which is probably going to increase prices because of supply shocks and it's going to lower demand as well. And I would also note that the stock market as well, as Sven Henrik noted in that interview, I'll put it up in the cards. He said we are at levels, or were just before the last 2 days, where the stock market cap was 159% of GDP, which is like a record as well. So there you go. And that's why I think whatever the central bankers do, or even the governments through fiscal policy, they'll be pushing on the string. Maybe that's not a bad thing, because we do need a correction. We do need a flushing out of the system. That's what nature does, and that's what markets and economies should do. We should have cycles, and let's hope the crisis doesn't get worse. But for now, we don't know, and that's why I think things are going to remain very volatile out there. So if you enjoyed this video, please hit the like button. Think about subscribing to the channel if you haven't yet. Share this video far and wide, and you can also follow me on Twitter, Facebook, BitChute, DTube, and Steemit. I wish you all a great day. Take care. Bye.